If you're below 5 to 10%, you're really not making enough money. So you have to analyze if your gross profit is too low, you're not charging enough for your project, or you have just too much overhead or too many costs.
So a budget. One of the things, we did a video, I think it came out on Successful Contractor, but we did a video where a lot of people, especially in the fence industry and other industries, will just go out and bid things per square foot, per whatever unit of measure they want to use. For us, it would be per linear foot, and that's a pretty dangerous game to play because you haven't created that budget. And it can vary wildly based on conditions, and it can vary wildly based on how large the job is, how far away the job is. When you do that, you're treating every job like they're all exactly the same.
Right, and they're absolutely not. And that's why you have to budget for each one of your jobs and the job types. So there are jobs, I'll give you an example. We have had clients, they are in multiple industries. So say like they sell gravel. Mm-hmm. And then say they actually do highway contracting, which is, fairly common. And so when you have that, your margins on your gravel, a lot of times you will try to crank those margins up to be competitive with your other stuff. But when you lose that volume of sales, you're not covering overhead anymore. So globally, the business is losing, even though they're selling stuff at a lower margin, maybe in one component of it. When you get rid of that component, though, that component was covering overhead. And so if you eliminate that segment of it and aren't covering any of that overhead burden through that segment, your actual company overall is losing money. So there's a lot of thought process that has to go into each one of these.
Mm-hmm. So what should my profit goals be? If I'm a contractor and I'm getting into this, like how much should I be making at the end of the day, net profit?
Because it really depends on the industry. So each industry, like fencing, electrical, highway, they each have different goals. But I would say in ranges, and I'm saying this on the low side. So this would be your minimum net profits. So like in a typical construction contractor, your minimal net. Now this is your net, your bottom line profit. We want to see between 5 and 10%. If you're below 5 to 10%, you're really not making enough money. So you have to analyze if your gross profit is too low, you're not charging enough for your project, or you have just too much overhead or too many costs. So 5 to 10% on the bottom line. But your gross profits, typically gross profit wise with overhead allocated, so like pure job costing, we'd like to see you somewhere between 15 and 25%. So those are typical, to end up with a 5 to 10 net, you have to be 15 to 25 on the gross profit margin. And again, gross profit is your sales, less your materials, less your subcontract, less your labor. That's your gross profit. And then we allocate overhead to that. It's a pretty complicated formula to do that, but that gross profit really needs to be between 15 and 25%. So if you're only looking at your direct costs and you aren't looking at the overhead you're allocated, you need to be at a minimum of 25% and upwards of 50%, just without overhead allocation, just on your direct expenses. Again, that would be your labor, that would be your materials and your subcontract. You want to be somewhere between 25 and 50% gross profit margin on those items.
And you're saying allocate overhead, so some of your overhead you're allocating to each project as well. So, yes. And sometime you and I are going to have to talk about that, because I'd like to know a little bit better way of going about that.
So what ends up happening is there are a lot of expenses that aren't directly related to the job that for financial statement purposes, we have to allocate some of those costs. So like interest, depreciation being one of the big ones, repairs and maintenance, because a lot of times those are attributable to jobs. It's just not a specific job. So we allocate those to overhead. That's a function the accountant normally would do.
Mm-hmm. So there was a profit report that came out. The AFA are our fence association that we're a part of or a member of used to do a profit report, and so they'd send out a survey to several different people. They'd send it out to everybody, and then I think there was probably 40 companies annually that participated in it. And so they'd group it, and they'd tell you kind of where the high profit companies were, the low profit companies. There was a ton of them that were under 5%. And one of the important distinctions I think we should probably make is that 5%, that should be after the owner's compensation's paid, right?
Absolutely.
So if you're making 5% and that doesn't include your pay, then really you're very, very low. There's nothing left probably to, like if you have loans to pay principal. So 5% after the owners are paid. So if we're not ever taking into account the owner's compensation, people will kind of inflate the value of their business because they'll think, well, I'm making 5%. Somebody else will come in and say, well, actually, if I had to hire a manager to come in and run this company and pay them $80,000, we're actually negative if you look at it, because you're underpaying yourself.
Yeah,
for what
and that's one of
pay.
the differences between like an LLC and an S corp. In an S corp, you have to take out reasonable wages, so those wages are calculated in there. So you're looking at a true profit in an LLC. The owners just take out typically distributions, so there's no wage built in there for the owner, so it overinflates your profit a lot of times. And a lot of times the banks don't understand that either. They don't understand that concept. But it's very important that you personally analyze it. It depends on the entity type. But between a C corporation and S corporation, that bottom line holds true. But in an LLC, your profit margin should even be higher because there's no compensation being paid out to the owners. They're taking out distributions. So
if your distributions are only showing up on the balance sheet and your profit and loss says that last year you made $50,000, but you took $80,000 worth of distributions, you're
going
negative
backwards.
30.
Absolutely.
You're backwards.
Yeah.
So financial ratios. I know that one of the things you do for us at the end of the year when we've got all our numbers complete, and we could probably do that mid-year too. There's a certain set of ratios that you run for us, and you tell us how we're doing, and you'll give us a benchmark and say, okay, we want to see above this or below this, and so what are some of those ratios that people should be asking their accountant to assist them with if they're not comfortable doing them on their own?
One of the things we do is exactly like you're saying, that as part of our analytical procedures of doing financial statements, we run all kinds of ratios, and we know what the industry standard should be for your industry. And then what we do is from that is basically we can recommend to you, we need more cash. We need more working capital. We need more equity in this thing. So, but some of the most important, again, of ratios are working capital ratios. So that's assets divided by liabilities, that working capital. And, there's different industrial standards, but what I'll say, like in gross profit margin, for example, that's your revenues less your direct costs, which would be, again, your labor, your materials, your subcontractors. Again, we've already said with that, we should be at, somewhere between 25 and 50% with most construction contractors on that. Your working capital ratios should be a ratio of at least 2 to 1. So your current assets should exceed your current liabilities 2 to 1. Your leverage ratios, so these are very important. So this is your debt to equity ratios, very, very critical. We don't want to see that ratio above 80%. We don't want you to be leveraged. We want you to have an equity position. So like if you're over leveraged, that's how we can tell if that ratio becomes over 80%. Your profitability ratio, and again, this is all over the map. But that's your net earnings divided by your total assets, because it tells us how efficient your assets are being utilized. Days of cash for a construction contractor. Again, cash is king. So you want a significant amount of days of cash. Preferably, 30 days to 6 months worth of cash on hand at year end. And we already talked about that current ratio. That current ratio is current assets divided by current liabilities. We want it to be somewhere between 1.25 and 2%. There's all kinds of different ratios that we use, but those are the ones that we key on the most.
So if you're wondering how your business is performing, maybe take those to your accountant or ask your accountant to help you look at those. And you can start with last year. Just say, hey, how last year? It's in the middle of the year, maybe not the optimum time. I know if we did our ratios right now, they'd probably be off because the first half of the year is usually it's usually crap.
Yeah,
And
usually
we don't start making money
January
until
through March, you have negative profits, and then your profits build after that. So it's kind of hard. But a mid-year, a mid-year kind of shows you trend lines. But year end, everybody should be analyzing those ratios at year end for sure, absolutely. And you can go, if you had a set of financial statements or tax returns, you could go into your accountant and go through those ratios. Even now, you could go back and look at the history of them. You want to see improvement in them, just like we look at yours. Yeah. We try to look at all of those ratios and say, okay, we want to work on this one and this one, and we typically see improvement in those numbers every year. So that's the goal. You have to manage. You have to manage these ratios. You have to manage your financial position as a construction contractor.
Yeah, and you can go back maybe 3 years, look at your. Have your accountant work off of your past balance sheets or your financial statements, and they can figure all these up, and you can see what the trend line is for your business, which would give you a really good indicator of which direction you're moving.
Absolutely.
If you feel like you're moving backwards, then you can figure out where maybe there's a problem. So how often do you recommend your clients consult with you? I mean, we talk several times a year, especially if I've got something big going on. How often do you feel like is necessary for somebody that's a construction company to seek their financial advice?
So with our construction contractors, we almost always meet with them 2 times a year. So, and this is before year end. So I'm talking about like before year end meetings. So we typically will meet mid-year just to see that we don't have any major problems going on. Some of my contractors I meet with every month, because we analyze their numbers and their job performance every single month. There are some that we just meet mid-year, and then we always meet with them November, December. Because remember, what we're trying to do is we're trying to coach that balance sheet and P&L as of December 31st. So your balance sheet, the only time that it really matters, it has to be extremely pretty looking December 31st. So we want it to look as presentable as we can. And there's small things that you can do right at year end that make a huge difference. After year end, there's very little we can do with your balance sheet and your profit and loss. And that's again why we try to meet November, December time frames. One is for tax planning. Do we need to do anything, to try to minimize the tax burden? And the other one is to coach that balance sheet along. We want that the cash to be strong. We want your working capital to be strong and your equity position to be strong. So even though it's towards year end, we still usually have a month to be able to position ourselves to maximize basically the appearance of our balance sheet.
Yeah, and I know that's one of the things you've coached us on is at the last little bit, just stack cash.
Yep.
Stack cash.
Yep.
And that works
Try
really well.
Try to collect as much cash as you possibly can. Try to get as much work done to be able to book that revenue in. And basically there's just little tweaks that we do, but that's the importance of it. And like I say, like if you're, one of the things that we're doing is with our newer or expanding construction contractors, we're just getting online with them and reviewing their financials. It literally only takes a half an hour. And we're doing that each month with them, especially anybody that we're seeing any slide in or that are having problems with controlling their job costs and their overhead. We're really trying to help them manage that. And so there may be a little more involvement. And again, the problem is trying to find an accountant with that level of expertise that they can get in and get out and basically help consult with you to basically turn those things around so you don't have business failures. And so you really need to be dealing with your accountant multiple times during the year, not just after year end doing tax preparation. There's more to it than that.
And the more trouble you're having, or if you feel like you're going backwards or you're in a position where you're losing money, having their assistance to help you figure out why that may be that's
absolutely
the time to
critical.
step up.
That's the time. Because a lot of times, historically, a lot of times have relied on their bankers for that. Bankers are very generalized people. They're not specific to your industries. You need to find a good accountant that has experience with construction contractors to know how to consult with them. Because if you're relying on your banker for that information, you have a high probability of business failure.
Yeah, and it's not uncommon for a banker to call you up and say, hey, explain this stuff to me.
Absolutely. Happens all the time.
Yeah. I know that when we were talking to banks, they would call you up and say, okay, tell me what you know.
Yep.
Do we have your permission? They'd call me and say, do I have your permission to talk to James? Yeah. Ask away.
Yeah.
So
one of the things that we really struggle with is a lot of times, like the banks want interim information. And if we get certain clients that they don't have us review that information. We had one client that there was they have a point of sale and there was a misposting of their inventory, so it overinflated their profits by $1 million in one quarter. And they're not aware enough that they didn't see that extra $1 million profit in that quarter on their financials. They give it to the bank, and the bank's going, "Oh man, we can't rely on your accounting system. This is a disaster." So
yeah.